What's up everybody, welcome to Money Management channel. My name is Andrei and today I want to zoom out a little bit and show you the bigger picture of the markets right now. And on today's video, first of all, I will show you where we are on the chart right now and how we get there. Then I will continue with amazing news and I will show you that the Federal Reserve most likely just started new medium-term bull run. And at the end of this video, I will share my thoughts and I will show you what should we expect from the markets in upcoming future. And before we get into all of that, if you guys would like to earn 2 free stocks with Moomoo valued up to $7,000, please check out that link in the description below. All you have to do is sign up for an account and deposit as little as $1. This is guaranteed free money. Full details you can see on the screen right now. So let's start with the price chart. As you can see, we are on S&P 500 price chart, and from its all-time high on January the 3rd, it went down for about 12.34%, and we have very good bounce. And right here, as you can see, the bounce has a huge increase in volume. On top of that, if we switch to Nasdaq Composite Index, we have absolutely the same picture, but the top of this index was on November 18th, and since then it fell down for about 18%, but for now it also has a good spike in price for about 8.76%. So what was the reason of this sell-off? We all know. And it is the tightening of Federal Reserve's policy and the hike of interest rates. But what was the reason of the most recent spike in its price? And let me show you this news. We are on Reuters.com and this article was published on February the 1st and it says, Fed sees March rate hike, but no roadmap after that. And let me quote you this. Federal Reserve policymakers say they will raise interest rates in March, but spoke cautiously on Monday about what might follow, signaling a desire to keep options open in the face of an uncertain outlook for inflation and a pandemic still ongoing. And let me quote you this. We definitely are poised for a March increase, San Francisco Fed President Mary Daly told Reuters in a brief phone interview. But after that, I want to see what the data brings us. Let's get through Omicron. Let's look at this and let's see. And she also added that inflationary pressures will likely ease in the medium term since we still have an older population, weaker productivity growth and a lower neutral rate of interest. And while inflation is largely demand-driven, the Fed's recent monetary shift will reduce demand, which could re-establish supply chains, Daly notes. On top of that, let me show you this article. We are still on Reuters.com and this article was published also on February the 1st and it says, Fed's George, aggressive balance sheet reduction may allow for fewer rate hikes. And let me quote you this. The Federal Reserve can move sooner to start reducing its bond holdings than in the past, and aggressive action to shrink the US central bank's portfolio could allow it to take a shallower path on interest rate increases, Kansas City Fed President Easter George said on Monday. On top of that, we have another person, and we are on CNBC.com, and this article was published on January 31st, and it says, Federal Reserve's Barkin says businesses would welcome higher interest rates. And let me quote you this. I'd like the Fed to get better positioned. We think we've got a good path for a year to get there, he said on closing bell. I think how fast we go just depends on how economy develops. So basically we have 3 Federal Reserve officials who told us absolutely the same. They will increase the interest rates in March, but after that, most likely we won't see any increase for at least 3 to 6 months. And let me show you this again. What we do on the balance sheet is likely to affect the path of policy rates and vice versa, George said during an event organized by the Economic Club of Indiana. For example, if we took more aggressive action in pulling down the balance sheet, it might allow for fewer interest rate increases. So, and as you might remember, Jerome Powell didn't say in his speech about a week ago when and how severe they will reduce about $9 billion in their balance sheet. And as you can see, if they will pull down that balance sheet aggressively, this means they don't need a huge increase in interest rates. And definitely, this will lead to next potential bull run on the markets. On top of that, let me show you the 10 years treasury bonds. And for now, it is at 1.798%, and definitely, as you can see, during the entire year, it is the all-time high levels for the interest rates. And with this increase, basically from August till present day, it surged up from 1.151 to 1.798. And definitely this increase might be very supportive for the stock market. And that is why, as you can see on the heat map, S&P 500 1-week performance, we can see more green color than the red one. This means, most likely, let me show you again the price charts of Nasdaq Composite, and let me switch again to S&P 500. Most likely, this bottom of $420 was the local bottom for the entire price action. And definitely in March, potentially we might see another leg to the downside. But in my opinion, we won't break this support line that this asset established with its lowest price point. And if my assumption is correct, we will continue to see the next bull run at least in the first half of 2022. On top of that, let me show you that because of high correlation in between cryptocurrency market and traditional stock market, we have a bull run on crypto markets. For now, the global crypto market cap is $1.78 trillion. It is a 1.92% increase over the last day. And as you can see, even on a 7 days period, all major cryptocurrencies have a huge gains to its market cap. And definitely, on the crypto market, we also might see next major bull run, at least for next 3 to 6 months. So I think it is quite interesting information, and if you like my video, please hit the like button and subscribe to my channel with notification bell, and see you guys and girls next time. Bye!